As we've seen, there are a number of reasons why bond prices change. Let's identify the key factors that will have an impact on the price of a bond and then explain each one in more detail. Changes to interest rates. The bond is an interest rate product, and any changes to current interest rates for the maturity of a bond will have an impact on its price. The liquidity of the bond. Just like any other traded asset, if a bond is in short supply and many traders want to buy it, its price will go up because of the demand. Changes to the credit spread of the bond. The credit spread is part of the interest rate that affects a bond's price. Changes in the market's perception of an issuer's credit rating will affect this spread, which in turn will change the price of the bond. And in addition to these factors, there is of course the general supply and demand for a bond. It's a traded market after all. So let's look at these important factors one by one. When a bond is first issued, investors consider whether its coupon interest is appropriate for the credit rating and maturity of the new issue. They ask themselves, is the coupon interest on the new issue the same as could be earned if I invested in a bond issued by another government or a company with the same credit rating and maturity? If the coupon interest was lower on the new issue than could be earned on equivalent bonds in the market, then no one would buy it because investors could earn a better return elsewhere for the same risk. Therefore, if an issuer wants to sell their bond to investors, they must ensure that it gives investors a competitive return. It must have a similar return to that which can be earned from other bonds in the market. Changes in the yield to maturity of bonds are why bond prices change. Why is this? To answer this question, we need to know how changes to the yield to maturity interest rate affect a bond's price. Let's look at an example to illustrate this connection between a bond's price and its yield to maturity. Alpha Inc., a AA-rated credit risk, issued a 10-year bond with a coupon of 4%. At the time of the issue, the yield to maturity, or return, required by bond investors for a 10-year bond issued by a company with a AA rating was also 4%. The holder of the Alpha Inc. bond owns a security that pays an interest rate, the coupon, of 4%, in a market that expects a return of 4.25% for the same risk. No one will buy a bond at a price of 100% of the par value as an investment that only pays 4% when everyone in the market expects and can obtain a return of 4.25% for the same risk. The only way that Alpha Bond can become a competitively traded bond is if its price comes down to compensate for the 0.25% difference. In this case, its price would have to fall to about 98.11% of par to achieve this equilibrium. At this price of 98.11%, a 10-year bond with a credit rating of AA and a coupon of 4% is trading at a yield to maturity of 4.25%. The important observation that a bond investor can make here is that as interest rates, the yield to maturity went up, the price of the bond fell. Bond prices move in the opposite direction to interest rates. They have what's called an inverse relationship to interest rate movements. Using the Alpha Inc. bond again, let's assume that interest rates, the yield to maturity for this class of bond, fall to 3.5%. What happens to the bond price now? The Alpha bond pays a coupon of 4% in a market that only expects to receive 3.5% for a AA 10-year investment risk. This bond is a valuable asset on that basis. An investor holding this bond will be aware of its value and will want to sell it for more than its face value. Buyers of the bond will understand this as well and will expect this value to be reflected in the price. The price of the bond will therefore rise to more than 100%. In this instance, it will rise to above 103.88%. At this price of 103.88%, a 10-year bond with a credit rating of AA and a coupon of 4% is trading at a yield to maturity of 3.5%. Now we know from the previous page that bond prices and interest rates have an inverse relationship. In this case, interest rates fell and the price of the bond went up. So let's take a moment to summarise what we've discovered about the relationship between bond prices and interest rates. If the yield to maturity of the bond is the same as the coupon, then the bond will be trading at its par value. That's 100%. If the yield to maturity of the bond is lower than the coupon, then the bond will be trading at a premium to its par value. The price will be above 100%. If the yield to maturity of the bond is higher than the coupon, then the bond will be trading at a discount to its par value. The price will be below 100%. Actually, a bond can be traded on its price or its yield to maturity. The two factors are interchangeable and represent the same value. Many bond trading screens will show yields rather than prices because it's easier to compare the yield to maturities of different bonds rather than to compare prices. The liquidity of a bond refers to its availability for trading, how easy it is to trade it, in other words. Government bonds are generally very liquid, and investors are able to find such bonds quite easily. During the period after first issue, maybe up to 1 year, individual corporate bonds also tend to be readily available for trading purposes. As time goes by, institutional investors tend to buy the most interesting bonds, and these large investors are often more interested in keeping the bonds until they mature. This results in the bonds becoming scarce. Their liquidity begins to decrease as time goes by, so how does this affect the bond's price? If anything is scarce in a traded market, its price goes up. Bonds are no different. If lots of investors are interested in buying a particular bond, its price rises above what would normally be expected for a bond of its credit rating and maturity. This difference between the expected price of the bond and the new increased price is known as its liquidity premium. The liquidity premium is elevated at times of market stress and can affect both buyers and sellers of bonds. For example, a seller who needs to sell a bond which is subject to market illiquidity may have to accept a low price, or perhaps may not be able to sell the bond at all. The liquidity premium effect can therefore impact you as a buyer or a seller, depending on whether you need to buy or sell a particular bond. The previous page of this topic explained the inverse relationship between bond prices and yields. If a bond is subject to a liquidity premium, its price will rise and its yield to maturity will fall. As an investor, if you identify a bond in which you would like to invest and the price looks high, it could be due to the bond having a liquidity premium. How do changes in a bond's credit spread affect its yield to maturity? The yield to maturity on a bond is made up of two things: a risk-free interest rate and a credit spread. Traditionally, it's been assumed that because governments can borrow their own currency at the risk-free rate, they can't become bankrupt. Today, that's not quite true anymore. We only have to consider Greece's situation in the Eurozone to see that we cannot apply this logic to every government. In the case of Greece, the government has to borrow euros, which is not exclusively its own currency. Nevertheless, the approach of the market is to assume that there is a risk-free rate at which most governments can borrow, and because companies can default, they must therefore pay a credit spread premium over the risk-free rate. The size of the credit spread depends on a company's ability to service the bond issue. The larger the credit spread, the more probable it is that a company could default on its debt. Together, rating agencies and the bond market will dictate what the credit spread should be for particular corporate debt issued for a specific maturity. This means that if the credit spread increases on a particular corporate bond, its price will fall because its overall yield to maturity interest rate has gone up. Conversely, if the credit spread reduces on a corporate bond and the issuer is perceived to be a better credit risk, its yield to maturity will fall and its bond prices will rise. So that's the end of the course. Let's do a quick summary of what we've covered. If the current market interest rate, yield to maturity, for a particular class and maturity of bond is below the coupon rate, then the bond is more valuable. This is because it pays the higher interest rate and will therefore trade at a premium to par to cancel the difference between the yield to maturity and the coupon. If the current market interest rate, yield to maturity for a particular class and maturity of bond is above the coupon rate, then the bond is less valuable. This is because it pays the lower interest rate and will therefore trade at a discount to par to cancel the difference between the yield to maturity and the coupon. The trading liquidity of a bond can also affect its yield to maturity and therefore its price. The price of a bond will rise if it is in demand by investors. This will cause its yield to maturity to fall. Government bonds typically trade at the risk-free rate for a currency, but be aware that there are exceptions to this rule. Corporate bonds trade at the risk-free rate plus a credit spread. Increases in the credit spread will cause a bond price to fall. Reductions in the credit spread will cause a bond price to rise.